All right, I hope you guys are excited to join me for this free masterclass session, specifically free stock market investing masterclass session. And my goal is to provide a lot of value for you guys so that at the end of this session, you will feel like you are a better investor for investing your time to listen to what I have to teach you. And yeah, before we get into the details of the presentation, I just want to give you guys a summary so that you know what you're in for. We're going to first go over the essential but often overlooked concepts by many new investors. These are things that aren't necessarily strategy specific, but that's the reason why I'm going over them first, because it's something that gets easily overlooked just because of it's not strategy, when in fact it is very important and plays a big role in you being a successful investor. Then we're going to talk about valuation metrics to select in good companies. And when we get into those strategy type ratios, I just want you to be aware of the fact that the ratios are relative for the specific industry that a company is in. For example, let's say a PE ratio, which a PE ratio for a finance company should not necessarily be compared to a PE ratio of an oil company, because they have different requirements because they're in different industry. And then lastly, we're going to talk about the resources that will allow you to be an independent and self-reliant investor, so that at the end of this presentation, you'll feel more confident in terms of your ability to be a good investor in the stock market. And hopefully that'll get the ball rolling in the right direction of you becoming more financially independent, or better managing your retirement so you can retire early, or allowing you to create generational wealth, or just an extra passive income, because I know some of you guys just want to invest just for extra income. But a bit about me before we get into the presentation is that I'm a trader and investor and an entrepreneur. I'm also an author. I've been a successful investor for over 5 years now. And this strategy that I'm about to teach you is basically my fine tuning of what works and what doesn't work over the past 5 years of me investing. I'm also an expert day trader, and I use a lot of those experiences as a day trader to amplify my investing skills. So I take the best from trading and I take the best from investing, and I combine them in order to create a very valuable, reliable, and powerful investing training program for you guys to become better. And I'm also an author. Like I said, I've written a book now, one book, ebook, because I do realize that a lot of people don't take training programs. So I also want to have that option out there available for people in different parts of the world who doesn't necessarily have access to the valuable things that I will be teaching in my program. And I've had some success in investing. Like I've said, I've invested in stocks that are up more than 700% in a few years. I also made around 94% return on my investment in about 1 year. And I work at a private investment bank. But by working at that bank, I realized that it's not corporate. Desk job is not necessarily for me. I'm definitely an entrepreneur spirited, and I definitely want to do something that's valuable and can help a lot of people, as opposed to crunching data and number to make a company have more profits in their bottom line. So yeah, this is what I love to do. I love sharing knowledge and helping people. And that's essentially why I created Life Changing Investment, is because I wanted to help people and show them that stock market investing is a real and reliable path for you to achieve your goals. Because I know a lot of people aren't aware of it, and also a lot of people think it's extremely confusing and that it's very difficult to learn. But I'll show you guys how to make it simple by breaking it down for you guys. And yeah, this is my book. It's called Quit Your 9 to 5 Job, Stock Market Investing for Early Retirement, Escaping Work Fatigue or an Unfulfilling Job. Not necessarily telling you to quit your 9 to 5 job, but essentially, if you put in the time to master what I will be teaching in my program, and parts of it are in my book, not everything, of course, because it did take me a lot of investment and time to come up with these amazing strategies. So I can't give everything away in the book, but the book definitely does cover some of the things in this presentation and definitely gets the ball rolling. And I also want to share with you guys another powerful mindset thing that a lot of people also overlooked. And really, that truth is the recipe for success is the same in business, in sports, music, and investing. And now I know this sounds a little bit skeptical because basketball players have different skill set than CEOs. But when you really think about it, there's this thing called the 80-20 rule. A lot of people talk about it. Tony Robinson and Les Brown, they speak about 80% of your success being correlated to your mentality and about 20% to your skills. And this does seem skeptical at first. I didn't believe it, but then I realized as I try to work at things that are more difficult to achieve, that like the harder the thing is, the more truth you'll find with this statement. And I found that you really got to be hungry, you got to be optimistic, you got to be motivated, you got to be determined, enduring, and consistent. And you don't want to be lazy, you don't want to be negative, you don't want to be quick to give up, impatient, unwilling to learn and adapt. And really think about this: if LeBron James or Oprah Winfrey or Jeff Bezos or the Iron Man of this generation, Elon Musk, were lazy, negative, quick to give up, impatient, and unwilling to learn and adapt, will they be who they are today? Will they be successful? Now imagine if you were all of those things for your job right now. You didn't want to learn the skills that you were required to learn to do your job properly. You were negative with your manager, you were lazy, you gave up quickly, and you were impatient. It would be very difficult for you to be successful at that job. In most cases, a lot of people would expect you to be fired. But if they're kind enough to keep you around, they're probably not going to promote you. So your mentality is definitely a huge portion to becoming successful, and 20% is based on your skills. So I just want you guys to remember that. And the reason why is because investing is not necessarily easy. It is simple, and I do make it very simple for you guys because that's what I'm good at doing. I'm good at taking complicated things and teaching it to people. But that doesn't mean it's easy. But it will be easier if you enjoy it. And what this means is that you can't necessarily buy experience. You can learn from me, and I can teach you to decrease your learning curve so you can dramatically learn very valuable things in a short amount of time. But you still need to put in the time and effort to build your experience. Because imagine if Steph Curry or LeBron James or Oprah Winfrey give you a presentation on how to become as successful as they are. It's gonna have a lot of value, but if you don't put in the work and gain experience, it's not gonna get you anywhere. So the experience part is where you really have to put in the time. And I know a lot of people necessarily didn't realize the importance of investing, but you have to understand majority of the populations are working class, and 401k is the new thing now, especially for a retirement plan. And if understanding how to invest is so beneficial for your retirement that it can save you from the traps and pitfalls that a lot of people fall into, especially like the Bitcoin hype when it was 20,000 and crashed. There's millions of penny stocks that people fall prey to and lose their retirement investment on. So this program will is beneficial to helping you not only understand how to invest better, but also how to avoid the pitfalls and traps that are out there in the market. And now, another bonus wisdom, again, before we get into it, is that the best investment you can make is to invest in yourself. If you think about it, people are one of the most valuable resources on the earth. Every materialistic possession has value because we ourselves as people give it value. So therefore, the best investment you can make is in yourself. The second best investment is to invest in others because of our importance. The third best is saving. It doesn't matter how much money you make. If you're a millionaire and you made $999,000 a year, and at the end of the year, if you're a millionaire and you spend $999,000 in one year, at the end of the year, your net worth is 1,000. If you were a working class person and you made $50,000 a year and you spent 20,000, then at the end of the year, your net worth is 30,000. So you're there. The working class person is therefore 30 times more richer than the person who made $1 million and spend it all. So saving is very important. And the fourth best investment is to invest in the stock market, in my opinion. I'm biased, of course. But guys, think about this. There's a reason why there's hedge funds, investment banks, and all these very famous and wealthy people that are investing millions of dollars in the market every year. It's because the market has the potential to make you very wealthy and very profitable. You just have to put in the time to learn the skills properly. And this is what I'm here for, to help you learn the proper skills in order to become good at it. And you also have to become a prolific tester. When you think about it, and testing in the sense of testing a strategy or just testing things out to build your experience. Because when you think about it, the best scientists, they test, the best CEO, they test products. It's always, you want to test and you want to see what works for you and what doesn't, and take the best of my knowledge that will work for you and maybe discard the thing that won't. uh, it probably would be very hard to find something that won't, because if it wouldn't work, I would not be teaching it to you guys. Now, the concept that people overestimate and overlook about investment is risk management, or as I would like to call it, loss management. This is probably one of the most important thing. If you take nothing else from this presentation, take away the importance of risk management. And when I say it's important, I mean every institution that's respectable and know what they're doing in the market, even Warren Buffett or everyone, they manage their risk. And this is because the market is, and for beginners, the market is very counterintuitive, which is why you also have to focus heavily on risk management. It's because beginners, we tend to want to buy when something is up a lot. We're like, oh, something is up. That's proof that it's doing well and that it's worth investing in. And when something is down, that's proof that it's a bad company and it's not worth investing in. But in reality, it's the opposite. And that's why a lot of people get into trouble in the market. When you're buying something that's up, you're typically buying something that's overpriced. The institutions and everyone already made their money. So eventually they're going to look to take profits. And in order to take profits, a buyer must sell. So you're buying at when something is very high and people are already in the process or willing to sell it within weeks or days. And when it's low, you're panicking and you're getting rid of it because you're thinking it's a bad investment. You don't even want to touch it when it's going down. But in reality, especially if it's a good company, you're getting it at a discount. So that's the counterintuitive mindset that you have to shift as a beginner if you want to be good in the market. You want to be careful with things when they're up, either take profit or be careful with getting into something that's very high or already making a huge run. And you want to look at things that are down, not necessarily down, but they're pulling back and they would make, it appears that they're at a discount, especially if they're a good company. Now, you also have to only play with money you're willing to lose, because believe it or not, your psychology, like I said, 80% of your success will be your mentality. Your psychology plays a good role in this. And if you're investing too much and the market moves up and down every second of every day of every minute that is open, and your stock price will do exactly that. If you have too much in and you can't handle the normal movement of the stock price, then you'll be more likely to sell early and miss out on a great investment. So you have to know how much you're willing to lose. And then when you know how much you're willing to lose, invest an amount where if you lose X percentage, it's going to meet your maximum loss requirement. And you would have no problem taking that losses because you have to limit your losses. Because a lot of times I see people hold on to a stock that was up because they bought it really high and people are profit taking and they're still holding on to the belief that, oh, this is a great company. I can't let it go. I can't let it go. It's going to come back one day. And every single year it gets lower and lower and lower. And one day they wake up and they're like, oh, shoot, why am I down 50% on my investment? And so you really have to know how much you're willing to lose on that one specific stock and take those losses because the goal is not necessarily to win. It's to manage your losses to the point that when you do make a good investment and your investment win, it'll be 10 or 5 times your losses, and you'll easily make that money back. And then short-term investors specifically, you have to know when to take profits and walk away as well, because I just mentioned when things are up, people want to take profit. The real institutions also don't like buying overpriced stuff. So when they're taking profit or they're not buying, it doesn't sustain demands for a decent amount of company. There's always exceptions. You can find an exception right now if you look at a stock screener, but for the majority of the time, the probability is that things that are running very, very high are going to come back down. So you got to know when to take profits. And you also have to realize that the market goes up over decades, but many stocks do not. And this is essentially because the stock market is a collective of fund. But stocks and the stock market, especially the S&P 500, which is basically the stock market, they take 500 of the best company. And when a stock underperforms and they don't meet the requirement, it gets kicked out of the S&P 500, and the S&P 500 pulls in a new stock that's going to be performing well. And that cycle of kicking out and pulling in something better is what allowed the market to keep going up over time. Whereas the stocks that are getting kicked out, they're going to go bankrupt or sometimes out of existence. So don't fall for that trap, guys. This is why I'm here, to let you know the S&P 500 can and will technically go up over time, even though it may have pullbacks, but individual stocks, they don't have to, and many of them don't. Only the really good ones. There's always the exception, like the Apple, the Amazon, the Google, the Netflix, the Facebook, the Microsoft. But a majority of stocks, especially the terrible penny stocks, they're getting kicked out and delisted and bankrupt pretty much every single year. So a lot of people don't know that. So there you go. You already got valuable information right now. So let's keep it going. This presentation is going to be a little bit long, but all value, a lot of valuable information to help you guys become a better investor. And the next thing that's important that people overlook is discipline and patience. Like I said, 80% of your success is linked to your mentality, 20% is your skills. And you really have to think about this, guys. Come on, I know you know this. The best at anything that they do are usually the most disciplined and patient enough to stick through it. Investing is absolutely no exception. You'll find that investing and day trading, entrepreneurship is very similar to life, like sports and television stars and movie stars. Like, think about it. If LeBron James, Michael Jordan, Will Smith, Oprah Winfrey, Jeff Bezos, Warren Buffett, imagine if they were not disciplined and patient enough to stick through whatever struggle they had to go through to become who they are today. They would not be known. There would not be a LeBron James or Oprah Winfrey or a Warren Buffett or a Jeff Bezos. So be disciplined and be patient. Always be willing to learn and adapt. And another important thing is timing. A lot of beginners overlook this a lot, but you can think about this. You can invest in the best companies at any moment. But if you invest at the wrong time, you will likely lose money. And I've experienced it before I figured out what works, and now I'm way better at it. But when I was a beginner, I did not realize how important timing was because, like I said, overpriced stuff, people are taking profits and it could come back down. Whereas underpriced stuff, there's room for it to go back up. So understand that any investment, like I said, can be overpriced, and you should try to learn the necessary methods to time your investment when things are underpriced or fairly overpriced. And I go into this very detailed in my program. So feel free to check it out as well. I'll talk more about that later on in the presentation, but timing is important, guys. Timing is important. Try to get things on pullbacks. Don't chase the hype. There's always going to be exceptions. You're going to see those posts and you're going to hear those stories. That's because they're exceptions. That's why everyone is excited about it. But if they tried that with 10 different other companies, the loss will most likely pull away from that one gain that they had. So timing is also important, just to reiterate, is because stocks fluctuate. The value of a company or stock or the stock market changes all the time. Like I said before, changes every second of every day of every minute that the market is open. So timing is crucial. This is why day traders make a lot of money and they don't care necessarily about the fundamentals or value of a stock, because it's more about timing with day trading, which is way harder. Investing is way easier. And then diversification is also important. Some of you guys may not have even heard this term, but I assure you it's important. A lot of the institutions and hedge funds, they diversify their investment as well. And just to explain what that means to you is two words: in variety and division. And variety as in having various kinds of investments. You have ETFs, you have large cap stocks. I'll explain what that is. You have good companies, you have up and coming companies, you have gold, you have silver, you have gold and silver goes in opposite direction of the market. So it's a good countermeasure for a lot of good investors. When they think that the market is going down, they try to diversify by adding gold in there. And division is basically having multiple, kind of like what I said. So let's say if you had $100,000 and you would basically divide that up amongst the total amount of investment that you have. So let's say if you have 10 stocks and you have $100,000, you'll divide that $100,000 by 10. That's the division aspect. And the variety aspect is that you're investing in different types of asset to diversify the risk of, let's say you put in all your money in one stock and you made a bad choice and that stock lost money, you'll still be okay if you diversify. Whereas if you only had that one investment, you would basically lose all of your money. And smart investors, they never put all their money in one stock because it reduces the chances of them losing money when they diversify it. Another way to diversify investment, like I kind of mentioned, is to invest in exchange traded funds, since they are made up of many companies. So instead of an exchange traded fund, there's an ETF for the market, which is called the SPY, which is the ETF for the S&P 500. And it's just a collection of all the 500 different companies in the market. So definitely a nice way to diversify. Even the market itself is technically diversification because of all the different types of companies and industries that are part of it. And then there's also REIT, real estate investment trust. A lot of people like adding real estate to diversify their portfolio. And if you don't want to deal with real estate and the housing and the tenants and the property management, logistics, you can just invest in a real estate investment trust, which is basically a company that tries to simulate a real estate return on investment every year. And there's a lot of REITs out there. You can Google it and figure out, let's say, top 5 REITs to invest in. And then you also have to know your investment goals. So important, because how do you know your destination if you don't know where you want to go? Okay, it makes it much easier for you to understand what you need to do or what actions you need to take when you know what goals you want. So goals in terms of, are you a short-term investor or a long-term investor? Are you going to be a high reward but high risk investor? This is how the market works. When there's high reward, there's typically higher risk. Are you a low reward but low risk investor? Because when there's low reward, there's typically low risk. Or are you a retirement based investor and this goal will help you figure out what kind of asset you should be investing in. For example, the stock market. The stock market is very flexible in terms of those types of goals, but it can be typically considered a high reward and high risk investment if you're investing in those high risk stocks. But it can be a low reward and low risk investment if you're investing in those low risk stocks. And it can also be a balance if you're invested in very mature and old and valuable companies that don't see much up and down movement in stock prices. Now, the bond market specifically, the bond and the money market, they're technically considered low risk, but also low reward investment. And because of that, they're generally favored amongst retirement-based investors, because once you're at a certain age that you want to retire, you're not necessarily trying to make a lot of money. You're just trying to protect your retirement, because you don't want to go back to work when you're old and ready to retire. You want to enjoy your life and spend your money wisely. If you did not learn how to invest properly, if you learned how to invest properly and you took advantage of it, you probably would not be thinking about spending your money wisely. You'd be thinking about your next travel destination, if I were to be honest with you. But that's if you put in the time to master it. And then ETFs they're more balanced between bonds, money market, and stocks. They're less riskier than stocks, but they also provide a higher return than bonds and money market instruments. So they can be considered a balance. And there are exceptions. They're very volatile ETFs, but for the most part, because they're diversified and they have a lot of assets, they're typically a balance between everything. And then you also have to know the kind of investing you want to do, because based on your goal, it's going to tell you what kind of investing you should do. Now, growth stocks investing is the area that I like the most and that I play the most in, because when growth stocks are basically stocks that grows revenue rapidly, and because of that, they typically see a large increase in price compared to the average non-growth stock companies. And because they see a large increase in price, high reward, they can also see a large decrease in price, which makes it a high risk, high reward, high risk. But the things I teach you will allow you to basically eliminate that risk as much as possible to set you up for more success and let your wins overtake most of your losses, the way I teach it. And then value investing is kind of like a Warren Buffett style investing. Stocks that don't typically grow revenue rapidly, they have modest increase or decrease in stock prices, but they usually pay small amounts of dividends to investors, and people like dividend investment, and it's safe, but it's not if you want to make as much money as possible or a lot of money, growth stock investing, specifically the way I teach it, is a better way to go about it. And then there's income investing. A lot of people would consider dividend investing income investing. I typically consider it basically options trading, but options trading from the perspective of a long term, because options trader, the way you can set it up is that you can make consistent profit from selling options premium, and then if you extend your duration of your trades, you're basically investing. So I typically consider that income investing or income trading. And then this is it's time to get into the ratios and metrics that are going to help you pick good stocks. And this one is a common one, but it's worth mentioning because there's a lot out there. So I want to show you my favorite 4. And the first one, of course, is analyst rating. And the reason why I use these ratio is to filter out and select good companies. So with analyst rating, this will provide you a quick understanding of what most analysts think about the company. And what you want to pay attention to is the extremes, basically strong buys or strong sells, and you want to avoid investing in things that are strong sells. So use analyst ratings to filter out things that are sell or below, specifically strong sells, and try to avoid investing in them, because institutions, they control 80% of the market. They have trillions of dollars. Your $100, your $1 million, your $500 million is not going to do much compared to those companies where each of them have multiple billions or multiple trillions of dollars at their disposal to play with the market every day. So avoid investing in things that analysts think are strong sells, because the institutions, they hire these analysts, and typically if the analyst has an opinion and they're being paid by the institution, then the institution also has that same opinion. And then forward PE, which is one of my most favorite. I should have probably spoken about it first, but it's second, so let's get to it anyway. And forward PE, it's a little bit complicated to explain, but it's relative to the PE ratio. What you really need to understand, because I don't want to get into the formula and calculation, is that you need to understand that if the forward PE ratio is lower than the PE ratio, then you can typically estimate that the price of the stock may increase in a year, because the company is that's estimated to generate higher earnings. So when you see forward PE, you want to make sure that it's lower than the PE, specifically for growth stocks, because it just shows that the company is going to grow earnings in the future, or is estimated to grow earnings in the future. Therefore, the odds of the price going up is more higher than a company where the forward PE is higher than the PE ratio. And then there's the earnings per share for the next 5 years. This is also one of my filters. And I use this because when it's negative, it shows that a company is estimated to lose money over the next 5 years. So therefore, when it's positive, then it's a good sign that the company is going to continue making money over the next 5 years. So you want to avoid investing in something that has a negative EPS for the next 5 years, because if business, one of the main way to judge the success of a business is their profits. I don't want to be money hungry or say that business are just in existence for profit. So I'll just say the main measure of success is profit, not the entire measure of success. So you think about it, if a company is expected to lose more money over the years, it's not necessarily covering the main responsibility that it's in existence for, which is making profit or making money over time. So try to, definitely stay away from things that have a negative EPS for the next 5 years. And then market cap. This is important because it keeps you away from pump and dump junk penny stocks that, unfortunately, I see a lot of people on those Facebook groups and social media put their money into it, and they lose their money because penny stocks are very volatile. So market cap, it keeps you away from it, and here's why. Market cap is essentially the value of a company. When you hear that a company is valued at $1 billion or $1 trillion, they're basically looking at the market cap. There's mega caps company, but I just stop at large cap, and anything above is large cap. But you can technically include mega cap, then large cap, then mid cap, small cap, and micro cap. And investing in large, you want to focus your area of investment more in large cap, because they're safer, especially if you're not going to take if you're not going to learn as much as possible to become as good as you can. The safe bet is to just play with the large cap area, because it's less risky. The companies are more mature and more valuable, and they have a lower probability of crashing and losing all your money with them. But you absolutely want to avoid investing. I know day traders can make money off of it, but you want to avoid investing in micro cap companies, which are essentially penny stocks, the pump and dumps. And the reason, basically, anything below 300 million in market cap is a microcap company. I typically used to say anything below 200 you want to avoid investing in, but anything below 300 million you want to avoid investing in, because that's when you get into the penny stock area. And once you get below 100 million in market cap, then forget about it. Don't even invest in it. You can gamble and trade with it for fun, but a long-term investment, don't. The reason why you should not invest in penny stock in the long term, and guys, I know there's always exceptions. You can find a lot of exceptions, and then for every one of those exceptions, I can find thousands of the ones that crash. So penny stocks, 90% of penny stocks fail over time, and this is a well-known statistics by people who are good at penny stock, who are good at trading penny stock. So when you invest, you want to hold something for a long-term period to make as much money as possible. But if majority of penny stocks are going to fail over the long term, then you're just basically holding on to something and hoping that it doesn't do what it's likely going to do, which is to fail or pull back. So also a valuable takeaway from investing in large cap is that industry leaders, they make good investment, and large caps typically tend to be industry leaders. And when I say industry leaders, you're talking about Facebook is an industry leader for social media. We're talking about Microsoft is an industry leader for computer software or whatever. Amazon is an industry leader for e-commerce. Netflix is an industry leader for online streaming, and then Google is an industry leader for search. So you can see the value in large cap and industry leaders. And these companies are good and they tend to go up over time, whereas penny stock don't. And large caps are typically anything over 10 billion in market cap. Mid cap is anything between 1 billion and 10 billion. Small cap is usually anything between 300 million and 1 billion. And then micro cap is anything below 300 million. And nano cap is even lower than that. But these are basically the 1, 2, 3, 4, 5 main ones that you want to understand. Basically just understand the higher the better, the lower the worse, especially in terms of market cap. And then these are your resources that are gonna help you a lot, because I talk about those ratios and you're probably, some of you guys are probably like, I've never heard of what the heck he's talking about. He just confused me. And how the heck do I find those ratios? I'm about to go on Google right now and look for it. If you go on Google and you just search ratios, you're just gonna get an Investopedia definition or explanation of what it is. You want to use one of my favorite sites because it's user friendly. It doesn't have the most comprehensive, but it has so much and it's so user friendly and easy to use that I just love recommending it to people. And that's Finviz. And then for financial statements, a lot of those ratios, they're calculations made on financial statements. But if you want to look at the financial statements of a company because you want to do more digging and understand whether they're profitable or not, or how they grow money over time, then you can do that. So you can look at Yahoo Finance, and then you can also look at Morningstar. But let's go to Finviz. I'm going to show you guys how it works just to give you a small rundown of it. So right here, yeah, let's check this out. Let's go to Finviz. So Finviz right here. This is probably, yeah, this is definitely the website you want to be on. So you want to go to screeners right here. Once you open up Finviz, you want to go to screeners. You want to ignore that ad that popped up below. And you want to go to valuation. So you're going to click right here. And let's talk about, just to show you guys how much the stuff that I'm saying makes sense. So let's show you guys an example of companies. Say Apple, Facebook, Netflix, Amazon, Google, Hertz. Apple, Facebook, Netflix, Amazon, Google, Hertz. Guys, so you can tell I invest and trade a lot because I know these companies by ticker. it's like a walk in the park for me. So right here, you can see market cap, like I told you guys, billions, billions, billions. And the reason why I have Hertz basically went bankrupt and cost a lot of people a lot of money. And I just want to show you guys how it makes sense to not how my explanation of my ratios and stuff made sense. So you can see all the good companies, Google, Facebook, Amazon, Apple, Netflix, they have billions of dollars in market cap. Check it, their forward PE is lower than their actual PE ratio, which shows that they can grow money over time. Check it, all of these good companies. Hertz is, pay attention, it's below 300 million, and it's a company that cost a lot of people a lot of money. They got delisted and they went bankrupt. So what I'm telling you guys, this is live and valid proof that it actually works. And then right here, PE ratio is not even there. And what that typically means is that the company is losing money. Sometimes when you don't see the PE ratio, most likely it means that they're losing money. So it's not even positive, and then it's typically not standard to show negative PE ratio. And then check it, earnings per share for the next 5 years is not even here. But when I last looked at this, it was actually negative. I believe it was negative. So again, you want to focus on things that have positive earnings per share. All the good companies, they have positive earnings per share for the next 5 years. Check this out. And then analyst recommendation. You see what I said. You want to focus on stuff that are above a sell. So basically 1 is a buy, strong buy, and 5 is a strong sell. So you want to focus on stuff that are above a sell. So hold or better. And let me see if I can get what that translates to. If I can get it quickly right up on this sheet just to show you guys. Because I know I can pull it up, recommendation right here. So you go to performance and then you go to recommendation. Look at Hertz, a terrible company that costs a lot of people a lot of money because of COVID. Not necessarily terrible, but COVID made the company terrible because they lost a lot of money. So you can see Apple, Amazon, Facebook, Google, Netflix, they all have good analyst recommendation, hold or better, which is a 3 and above. And then you see Hertz, as the company gets worse, it gets closer to 3 and it gets closer to a 5. So as you guys can see, the 4 ratios that I did show you, they do actually work and make a lot of sense. And if you guys are excited about the value that I just showed you guys, then guess what? You'll be even more excited when you guys join when you see what I have to teach you guys in my program. It'll actually blow your mind away, the level of depth that you can get into. And now I just want to pull up Amazon. This is also a bonus. I'll show you guys another bonus thing to judge a company's health. You want to go to financials. This is the financial statements. So you can go to Yahoo Finance or Morningstar. Morningstar, they charge you now. I used to recommend it when it was free. It was a very good website. I'll just pull it up right now. It was a very good website for people to look at the financials, but I'll just show you guys a quick walkthrough in case you want to pay for it and you don't like Yahoo Finance. You can see get 14-day trial, so they're charging. So Amazon, you would go to financials, and then back in the old days, you could have went to income statement and then you could have seen the information. But as you can see, they have the plus sign, premium they want you to pay. So for now, we're going to stick to Yahoo Finance for sure. And then, so let me pull up Yahoo Finance. Let me pull up Amazon just to show you guys something clever right here. So remember what I said about profits being important for a company and growth? So you can see it in the income statement right here. Amazon, and the reason why I pulled up Amazon is because you see operating income. Let's see. Amazon is actually a bit, you know what? I forgot that Amazon is actually a bit confusing. So I'm actually a better example so I don't confuse you guys, because you need the model before you start getting complicated. So I'll show you guys a model just to help you better understand it. And let's look at the, why does it keep showing me Python? It's like Python. Guys, let's go to financial Yahoo Finance. Stop playing games, Yahoo Finance. I'm trying to help people here. Trying to make them better. Okay. So you see operating income. Guild is a company that's been trending down. The stock price performance has been dropping, and and you can see how that drop is tied to them not making as much money as they used to, because in 2016 operating income was higher and it got lower in 2017, then it got lower in 2018. So you can definitely see the correlation between how the stock price is actually, let me refresh this, of how the stock price, and then how the stock price definitely reflects whether the company can grow earnings or not. So you can see in 2018 it got even lower, 2019 it got even lower. So let's try Facebook, because Facebook is profit making machines, although I know you guys don't like it as much as you used to because of the ads. So you can see Facebook stock price keeps going up, how it's tied to earnings. You can see 2017 it was 20 million, 2018 it got higher, 2019 it kind of leveled off, but you can see 2020 it's not over yet, but profits are increasing. So you can see good companies tend to show increase in profits over time, and bad companies tend to show decrease in profits over time. So and Guild is not necessarily a bad company, it's just been on a downtrend. So that's a bonus that I just gave to you guys, and it helps. It definitely helps when you are able to look at the company's financial statements and see that they're growing revenue over time, especially if you're going to use a growth strategy, which is of course what I like to use. And also, if you guys want to use more ratios, because there's many more ratios, and if you want to add stuff to the other four that I give you, because you want to get more involved in it and play around with it and become a prolific tester, then feel free to check out these links that I'm giving you in this presentation. You're mainly going to find information on what the ratios, extra ratios mean on Investopedia. So we got the analyst rating, the forward PE, the market cap, earnings per share, the share outstanding, and you get the PE ratio, EPS, the analyzing price to cash flow ratio. You can add the price to sales, the price to books, the price to cash, all on Investopedia. You can also add short interest. You can look at the stock's daily volume if you want to as well. And you can also look at operating cash flow, understand why it's important, because it definitely is important. You can understand negative cash flow, the profit margin ratio, and return on equity. And then also we got debt to equity ratio, the current ratio, the quick ratio versus current ratio explains how they're slightly different and the benefits and disadvantages of those ratios. And then before we wrap up the presentation, I just want to talk to you guys about the training program. So you see I have basically three different types of program, but it's broken up into four. So the basic is $12 a month, and the standard is $49 a month. And then the advanced used to be about $1,999 a month, but then I dropped it to $1,797. So you definitely get a discount on that. And if you get that, it's a one-time payment. So if you, and you have access to it for life. So if you get that, you also get a bonus portfolio and a stock selection session with me. And there's the advanced payment plan, which is it breaks down the original price of 1,999 over 3 monthly payments. And if you get that instead, because it's a bit more affordable and you can't afford the one-time payment, then you won't get the portfolio or the stock review session with me. So it's up to you on which tiers you want to choose. I try to make it affordable to other people, because I know sometimes people can't afford the higher price stuff, even though it's definitely beneficial and worth your investment. Because like I said, it's a lifetime investment. You have access to it as the course upgrades and changes and evolves and more people join. You'll have access to that for the advanced training program. But the other two, the basic and standards, it's just monthly payment. And this is what it'll look like on my website. If you go to my website and you go to the pricing page, you'll see $12.99, $4.99. You'll see the payment plan, 3 monthly payments, lifetime access, of course, once you complete the 3 payments. And then this one, the one-time payment, lifetime access. And what I just shared with you guys is definitely valuable, and it will help you become a better investor. As I just showed you on Finviz, you can see how the ratios and metrics that I showed you made sense. And even though this presentation was valuable, it addresses some of the standard strategies, but my 2 training programs, the advanced program and the standard program, goes into more details and cover more things, because there's definitely more. I gave you guys a lot of value for free, and you can definitely go off and be successful with it. But if you don't want to go through the traps and pitfall, and you want to use my experience and leverage that to give yourself the best chance of succeeding, then consider joining the program, because there's a lot of value. It'll blow your mind when you see how much more you can learn about the market. And specifically from the advanced program, because I use a lot of expert level strategy that can definitely increase your consistency and profitability with investing. And that's primarily because it teaches you to read and predict price increase or decrease better than a lot of different investors on basically any stocks or ETF. And of course, you guys get a lifetime access. So don't think about it as $17.97 now. Think about it as, for my entire life, I just paid $1,797 for something that can transform my life and make me better off. So yeah, don't think of it as one-time payment of $1,799 right now. Think about it over the course of your life. Break it down into days. It's a couple of cents a day. So yeah. And with that, just like to wrap up. So we talked about the essential but often overlooked concept by many new investors. Remember, guys, you want to pay attention to risk management. You want to pay attention to diversification, your timing, and you want to know your investment goals. Those things are very important, although people overlook it because they try to make the money right away, but you need to understand those. You also need to understand your mentality is going to be the main thing that's going to lead you to be successful. I can give you all the knowledge and teach you and try to motivate you, but at the end of the day, if you don't have the right mindset to put in the right effort and be patient and disciplined, then you're going to have a difficult time succeeding with anything, especially if it's something new that you haven't learned before. And then we also talk about the valuation metrics to select good companies. Just want to make sure you guys realize or remind you guys that when you're comparing ratios, especially if you go off and add different things that I didn't tell you about outside of my favorite four, then you want to make sure it's based on the industry. That you're comparing it to the industry average, and that you're comparing those ratios to companies in the same industry, because different industries have different requirements of what's a high or a low ratio. And then you also want to make sure you use the resource Finviz. You can check out Yahoo Finance if you want to look at the operating income and see if it grows over year, especially if you're picking a growth stock. But Finviz and Yahoo Finance is for sure uh, definitely amongst the top 5 most important resources. And with that, it's been a pleasure to educate you guys and allow you to see that there are definitely real and reliable opportunities out there to achieve your goals and transform your life. So we're talking about early retirement, we're talking about financial freedom, we're talking about generational wealth, and yes, we are talking about more time to do what you want with the people that you love. And if you're absolutely ready to take that next step to get on the path to achieving your goals and dreams and transforming your life, then feel free to join my program, and I'll see you guys there. Bye for now.